Back to my YouTube channel. So, what if I told you that one of the India's largest mining companies decided to split itself into five separate companies, not because it was failing, but because it believed breaking apart could make it more valuable? So it sounds very strange. Most companies dreams of becoming larger, but Vedanta chose the opposite path. So behind this decision lies a story filled with ambition, billion-dollar acquisition, environmental controversies, huge dividend payouts, and one businessman who repeatedly bet everything on his visions. So this story is completely based on Vedanta and why its biggest gamble may only just begin. So from this, if we start from scratch, we see the story begins in Patna. So a young entrepreneur named Anil Agarwal wasn't born into an corporate empire. His family traded scrap metals. Instead of staying in his family business, he moved to Mumbai with a bigger dream to build one of the largest natural resources companies. So in 1970s, he purchased a struggling cable manufacturing company. That small acquisition became a Sterlite Industries. So this company was its first acquisition, which was a very small cable company. I know it wasn't very glamorous, but it gave him entry into manufacturing and eventually metals as well. Because Sterlite manufactured copper rods and power cables. So that's where the copper mining, where Vedanta lies in now. So over the next 2 decades, acquisition after acquisition transformed Sterlite. The company entered into copper, it entered into aluminium, zinc, oil and gas. It acquired stakes in Hindustan Zinc. It's Hindustan Zinc in 2002, which is the world's second largest integrated zinc producer. It also acquired BALCO, which is Bharat Aluminium Company, which was privatized back then. It produces aluminium and power. And then Cairn India, which is an oil field and natural gas field. ESL Steel. It also acquired Rawa Field, which was owned by Videocon Group, Venugopal Doot. So every acquisition required financing. Much of it comes from borrowing. So after at the parent level, Vedanta Resources accumulated billion of dollar of debt. Servicing that debt required constant cash flow, and that's where dividend became crucial. Vedanta is very famous among investors for paying massive dividends. Shareholders loved receiving cash. So let's see whether Vedanta is actually creating value or simply moving money from around to manage its debt. So why the market did not reward Vedanta? So despite world-class businesses, Vedanta traded were often traded at lower valuation than many peers because investors weren't buying one business; they were buying everything together. That was oil, gas, aluminium, power, steel, copper, zinc. Each business has different economics, different risk, different commodity cycle. Analysts call this conglomerate discount. Instead of rewarding diversification, market often discounts its management believed that there was only one solution: break the company apart. And if we go a little bit back, so its first company, the parent company, which is Vedanta Resources, was listed in London Stock Exchange. So this gave Vedanta access to billions of dollars in international capital. So that money was used for acquisition, which was then where Vedanta had acquired big companies like Hindustan Zinc, Balco, Cairn. Okay, just a second. Okay. So in 2023, Vedanta announced a historic restructuring. So after regulatory approvals, the demerger moved ahead, creating five focus listed business. Each shareholders retained the parent company and received shares in newly carved out businesses on 1:1 approved scheme. So the businesses included Vedanta Limited, which was in base metals, including zinc, copper, and related business. Vedanta Aluminium, which was aluminium operated. Vedanta Oil and Gas, Vedanta Power, which was into power generation, Vedanta Iron and Steel, iron ore and steel operation. The objective was very simple. Each company would have its own management, its own investors, its own strategy, its own valuation. So instead of buying one complicated conglomerate, investors chose exactly which commodity business they would own. So did it work? Let's see. So the market welcomed the move. The newly listed companies together unlocked significant shareholder value after listing. Although individual businesses saw different market reactions. Supporters say demerger offers better valuation, better capital allocations, greater management accountability, more transparency. But main challenge remained the same, which was commodity business remains cyclical. So the parent group still needs more disciplined capital allocations, and investors continues to watch debt level closely. So the success of demerger will ultimately depend on execution, not just restructuring. So Vedanta's story is not about only metals, it's about ambition. One entrepreneur built a global mining empire from a scrap business. Then, after decades of expansion, decided that the business move to grow further was to break the empire into pieces. So whether this became one of the India's greatest corporate transformation or merely financial restructuring will only be known over coming years. So, but this is certain. Few companies have rewritten their own story dramatically as Vedanta. So, the biggest move isn't building something bigger, it is knowing exactly when to break it apart. So, let's see how market rewards this. So, this video was all about Vedanta, how it was started, a little bit introduction, it was started, and why the business split into 4 to 5 different sectors. So now all separate Vedanta Limited is are into 5 listed companies, and Vedanta entity continuing has one of them, making 6 operating businesses overall. And zinc business, Hindustan Zinc remains, which is already separated listed, and it is not split itself. So let's see what market rewards them and what not. So thank you for being with me, and let's see what does investor reaction make Vedanta now. Thank you.